2000, before the ascendance of ETFs was really evident. And I think there are a lot of parallels here. But in this talk, I want to really go back to the basics of why do we have blockchain in the first place. And it really starts out with, a lot of you are familiar with this, but the problems with our current financial system. This is a heavily centralized system. We rely on central banks, big financial intermediaries, fee takers, but it really exacerbates what the financial system is about. And this causes a bunch of adverse effects. We have billions unbanked, 1.7 billion. We have incredibly low financial literacy, even in the developed world. So less than 50% of people can answer basic finance questions. High costs. It's surprising in the developed world again. We have very low fees, but the average transaction fee is 7% on a normal transaction, which is crazy. Low trust in institutions and governments. This has all caused a trust problem, the centralization. Rising global inequality. We're all familiar with this. 1% of the world owns 47% of the assets. If you take that to 10%, you get down to 85%. This is generally a situation that is untenable. Currency manipulation through interest rates, what you're seeing in Venezuela, Turkey, and all of this is increasing systemic risk, which we'll get to in a little bit. And the answer, as you guessed, blockchain. At this summit, obviously, you're all familiar with blockchain and its uses, and you hear a lot of blockchain can solve everything, logistics, dental work. There are actually good things that blockchain can solve that it's appropriate for. Financial risk, decentralization of trust, and all the problems that come with centralization of trust. That is definitely the best use case. So let's think about why we have money in the financial system in the first place. It's really basic. Humans are a networked species. What makes us special is our exchange of ideas. We're the sum of our parts. And trade and exchange is about that. This is the accumulation of societal knowledge. And that's all trade is. So as we started out with barter, then specialization. And as this trade became more complex and less local, you needed something to facilitate that. And that was really the creation of money. Money came about spontaneously to address complex trade. So that's solving the coincidence of scale. If you want to trade eggs for a house, solving coincidence of locality. If you had a coal mine or a farm somewhere, if you weren't co-located, you couldn't trade. And the coincidence of time. Certain goods are either perishable or not. If you wanted to trade apples for a truck, let's say, they may perish by the time you could trade them. So you needed a secondary means of exchange, and this is money. And that's all it is. And it came out spontaneously. It wasn't willed by any government. It was to facilitate more complex and ever-evolving trade. So these are the things of money. That's the big thing that it solves in trade. So we covered medium of exchange. And when we think of money, we often think of currency. And these are the qualities of currency that it does well. So medium of exchange, we got that. Unit of account, very good at that. Durable, has a long, useful life. If it goes away, it's no good as money. It's divisible for small and large transactions. Portable, you can move it around, also complex trade. Fungible, each unit is the same. Now this last one, the stored value, even though it's equally listed here, is probably the most important aspect of money, and the one that our current currency system does least well. This store of value is incredibly important and incredibly hard to do. So let's think about that. Why is a store of value important? So when you talk about sound money, or hard money, this is all it means, is that it's a store of value. And the reason the store of value is important is because it allows you to make investment decisions based on just the investment and not have to worry about the degradation of the purchasing power of your monetary unit. The moment you introduce that, it raises your time preference. So this allows you to not plan for the future. So sound money allows you to do good investment, good capital allocation. Unsound money is the exact opposite. So when we talk about some of the problems in society, even the environment, short-term thinking, a lot of this is caused by our unsound money regimes. So there's broader implications to this stuff than just money. So our current system is incredibly bad at preserving value. So since 1900, the dollar, which is the reserve currency, has lost 90% of its purchasing power. this is generally untenable for anything else that wouldn't be issued by a government. This would not be a money that came about in the natural market. So this is exacerbated. This problem with money, which is our basic unit, is exacerbated and creates problems in the financial system. So all the financial system is to do four things. It's to facilitate value exchange, intermediation, that's to match savings and investors, risk transfer, and liquidity. Four basic things, and we want to do them as cheaply and with as little friction as possible. So this mess that we have now, this very complicated financial system, which even people of great financial fluency can't really understand, and the products that have exploded, derivatives, credit default swaps, all the things that led to the last financial crisis are still here, and just as complex and just as misunderstood. Now, the size and complexity of this financial system has grown. So we want the financial system to be as reasonably small and frictionless and costless as possible. Since the 40s, it's grown doubled in size to almost 25% of the productive economy. So the financial system should just facilitate other aspects of the economy, but it has grown into its own beast, and with it comes attendant risks. So this has been going on for a while. We say, so what? This has been over 100 years. It's very hard to get timing right. We had a financial crisis. Nothing's really changed. There's a few events that are going on that make this a little bit different and should concern people. So we have real hyperinflationary events. We're seeing stress on the periphery of the system. This is in places like Venezuela, Turkey. So the sickest men are starting to show signs of instability. Things like trade wars between powers. Often these things can turn into hot wars. Think World War I and World War II. So this is more instability. Financial instability. So we all agree that the financial crisis was caused by an explosion in debt. Since then, we've added $70 trillion in global debt. How can we solve the debt crisis with more debt? And then this is the big one that has changed really since 2008 and 2009, political instability. Our friends at Bridgewater, Ray Dalio, keeps this populism index, and that's the highest it's been since World War II. And this measures political movements that are on the extreme. So what we're seeing is a move to the right and to the left, but away from cohesion. And this is not the way you solve crises when they happen. This is the type of stuff that leads to very big political instability and then societal instability. And you see that in things like the breakup of the euro, Brexit, and stuff like that. So larger international economies are also suffering. All right, so now let's talk about blockchain, and specifically Bitcoin, and how it addresses some of these problems, specifically on money, but then like broader societal implications. So it's durable, just like fiat and gold. It's portable, much more portable than gold or fiat. This is truly a native digital currency. Fungible as well. Verifiable, that's a killer feature of Bitcoin. It verifies transactions without a trust center. Divisible, clearly, down to 8 decimal points. The digital scarcity. Now, if the thesis is correct, and you can actually only have 21 million Bitcoins, and that's all there ever will be, this truly will be the hardest money ever created. And throughout history, hard money has always forced out softer money. So that is a killer feature. The censorship resistance, also a killer feature. You're seeing Bitcoin used as the de facto currency in places like Venezuela, in places with political unrest. This is truly the first time a store of value is actually unseizable. Gold, other things that are physical can be taken, can be seized. There's no way to prove that you have Bitcoin. You don't have it. You have access to keys, which allow you to access it, but you can carry $1 billion of Bitcoin around in your head. You don't have to use that for ill or money laundering to not have your assets seized by the government. It's a completely legitimate use case. The one that crypto does not have a good mark on is established history. And it's only 10 years old. So I don't think there's any way it could have established history, and I would caution against any new technology looking for that, because you're not going to have anything new. But that is a real factor. Gold has been around for thousands of years, and people agree that it's got value, so that's very important. pause here for a second though. So this is what it does for money, but let's think about the broader societal implications of a trustless system. All the things that we're seeing, this inequality, this explosion of financial complexity and risks, and moral hazard, and elites abusing their powers, this is all a product of cheap money and a bad system. All of that goes away if you have a digital native currency like this that can't be manipulated, isn't controlled by one government. It is really a freeing thing. This is a societal leveler of incredible importance. And when people talk about ESG investing, social impact, I really think that there's no bigger social impact than solving some of these problems. Will it solve them? We don't know. It's a thesis, but that is the thesis. These are very, very important societal problems. Now let's think about this as an investment, and this is what we do at ARCA. We work with institutions, and it was nice to hear Sven say that institutions are coming to crypto. We're finding that too. And they have a completely different risk profile and investment committee procedures than retail. But they're actually starting to look at crypto as a serious asset class. And this is really why. And this is the way we talk about it for those investors. It's really potentially the best anti-fragile investment out there. And when we talk about anti-fragility, we're talking about Nassim Taleb's books, the statistician and best-selling author who wrote Black Swan, Anti-Fragile, and a number of other books. And it's really a cure for black swans. So a black swan, if you remember, is a hard-to-predict event because they're so rare, and it's an event of great impact. So it's a rare event that's hard to predict. The other part about black swans, which people often forget, is the third characteristic, is that after they occur, we generally look back at them and fit the narrative to what happened. So when we look back at the financial crisis, we think about, oh, it came out of housing, the packaging of these mortgages, it's clearly evident. We fool ourselves into thinking that there was a way to predict that, if only we had thought about it this way. That's not the way complex systems work. Complex systems have all these interactions that are very hard to predict, almost impossible, some would say. So you really need, what do you have that is a cure for black swans? Anti-fragile investments. So anti-fragile investments are actually things that do better in chaos or disorder. So he coined a word, which was interesting when I read this. The opposite of fragile, people often think of robust. So fragile is something that breaks or doesn't do well with chaos. Robust is something that is resistant to chaos, but anti-fragile is something that actually improves with disorder. So these are things like options, insurance policies, things with big convex payoffs. Bitcoin and crypto may be the greatest anti-fragile investment ever. So this is an investment, if the thesis is correct, that the more disorder there is in the financial system, the greater and more convex the payoff is. So when we think about where we are in crypto, people talk about the price. I think we just hit a new recent high at over 9,000. In January, starting an asset management firm, people thought crypto was dead again. It's become alive a lot faster than people thought. But the price really is not that important. Let's think about some of the numbers here when we think about price. So 9,000, what does it really mean? The entire crypto ecosystem, and that's all coins, Ethereum, everything, it's only $250 billion right now. And when I made this chart, only 100 billion. So we've doubled since then in a couple months. But let's say this is a cure to systemic risk. Might it be worth as much as an Apple, the entire ecosystem? That would be 4x from here. Let's say it actually replaces something like gold as a store of value. That's $7 trillion in value. That's 28x from here. So my only point is that it's incredibly early. If this thesis is correct, if this is a cure for systemic risk, we're incredibly early. It's internet early. In baseball metaphors, it's not the first inning yet. Baseball hasn't been invented. We're whittling bats. It's very, very early. And so when we talk to our potential clients, our LPs and our funds, we really pose it as portfolio insurance. And these are generally high net worth individuals. They're not interested in disrupting the social order or upturning financial systems. They're interested in remaining rich. No matter what, even if they go to cash or gold or asset, it is still in the financial system. They are levered 100% to the financial system. Our argument is, take 1 or 2% of your portfolio. I hope when we talk again in 10 years that this is a 0 or the worst performing asset in your entire portfolio. Then, like if you bought fire insurance on your house and it didn't burn down, you're not upset. People are still incredibly wealthy and everything's gone well. That is not what I think is going to happen. And I think they're going to be very happy that they have this portfolio insurance. And it's probably going to become a meaningful part of their allocation. And that's what's resonating with our clients. So if you want to hear more about insurance and systemic risk,